Hello, and welcome to the Banker's Tech Talk video series. I'm Joy Macknight, Deputy and Technology Editor at The Banker, and I'm joined by Hector Ibarra, CEO of Global Parametrics, which is taking a new approach to developing financial instruments to better manage climate risk in developing markets. Hector, thanks so much for joining us today.
Good morning, nice to be here.
So why would you say that developing countries really need to take a different approach to managing climate risk?
Let me try to address that through two angles. The first one, the social dimension. If you look at the stats, 93% of the poor and vulnerable live in countries that are classified as fragile and or environmentally at risk. And the other key number is 94% of disasters have been uncovered in developing countries. So this is a very social dimension. If we're really trying to help these populations to be resilient and grow, we have a big challenge. But the second part of my answer is probably looking at industry trends and global trends on weather. If you look at what's happening with climate change, there's a lot of issues going on around the world. It's not only the heating area, but also the change in rainfall patterns and storms is creating a lot of challenge in the world. If you couple that with more people living in vulnerable areas, population growth, you're having a problem that is getting very significant. The last point I just want to make is also the point that we're trying to mobilize capital investment in countries that require it. And with these secular trends on risk, it's very difficult to promote investments if you don't deal with climate risk. So we have a big challenge at hand.
Okay, but how should or how can investors and also insurers really take a different approach to risk modeling and taking into account climate risk?
I think the first thing I always say is you need to climate in a more holistic way. You cannot be looking at a very micro level. So when you're talking with bankers and they're investing they have regional programs or even global programs, you need to match the access to weather data at that level to make analysis relevant for their economic problem. I think the biggest challenge in the community right now is to find climate risk and climate metrics that are covering the whole world rather than looking at it regionally. And that's where Global Parametrics has focused its effort in terms of technology development.
Okay, but how do you use that weather data to maybe improve the risk modeling or improve risk management when it comes to climate change?
Well, basically, we recognize that we were funded by the government of England and by the development banks of Germany to try to create opportunities of financial products in areas where there's not a lot of data. You mentioned Africa, even Asia. If you start by looking at these countries, you need to realize that there's not a lot of data available. So your first challenge is what is there and how can I make it relevant? So you need to look at all ground observations, you need to look at satellite, but I think what Global Parametrics is pushing forward is going even one step further and start incorporating the physical models that the research community have been working on for climate forecast or climate change, and try to bring this scientific element and to add value into the problem of lack of data. So therefore, even though in areas where in the past it was very difficult to provide banks with a view of risk, we're starting to create the opportunity by using this technology. So you can see it as a coupling of ground observation, satellites, and physical models.
Okay, and coming back to your first answer, really, how does this really impact the socio and economic situation of the most vulnerable countries to climate risk?
I always like to bring people's memory to 2010 earthquake in Haiti, very few people know that the first cash that arrived to the country after the earthquake hit was coming from an insurance pool promoted by the World Bank called the Caribbean Catastrophe Insurance Pool. And I can name a couple of examples, but these rapid disbursement instruments are very critical when there is an emergency to be able to allow local institutions or governments to run emergency programs. So that's a very simple example because it has been already been proven, but we can talk about also we work a lot with microfinance institutions, and what we're trying to do is allow their networks to have what they call emergency lending programs. So basically, by using financial instruments, they can ensure the liquidity of these programs. So if there is a disaster, they can go to the clients, provide lending opportunities so they can redo their livelihoods. And there were excellent experiences. One of our key partners, Vision Fund International, had been running these programs for several years, and they in Haiyan, in Philippines, in Africa. So there's a couple of examples. But coming back to your audience, I think the banking community, I think these kind of tools also bring us to the realm of promoting more resilient infrastructure, allow investors to have a better sense of the risk profile of or being able to allow them also to deploy capital in areas that are more risky. So there's a couple of examples, but I would say that with financial instruments, you can think about, in the end, allowing individuals to get access to aid, lending, or even investment in a more efficient way.
Excellent. Thank you so much for your insights, Hector.
Pleasure.